Hello and welcome everyone to this latest weekly market recap for the week ending Wednesday, January 8th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. It's a pleasure to join all of you again this week as we take a look at a full week now that we've had in the stock market for 2025. Seen some good, we've seen some bad, so we're going to try and break it down for you today during the show, give you an idea, general sense of what I'm seeing to start the year and what this could mean maybe for the balance of 2025, or maybe that's a little bit too far out, maybe just for the balance of the next week or so. I do want to mention before we get started that the stock market is closed on Thursday, January 9th, in honor of late President or former President Jimmy Carter. So stock markets will be closed in observance for that for all his service and so forth. This is typical. We've seen that with other presidents as well. So nothing really out of the ordinary there. Also, we have a big non-farm payrolls coming up on Friday morning. So the next time the market opens, it will have some very important data to trade off of. If that report comes in hot, I think that is going to play into the hands of the bears. Where we have seen rates moving higher. We've seen many areas of the market selling off, especially the interest rate sensitive areas of the market. So that's something maybe to keep in mind as we move into Friday. If that report comes in, with positive jobs, but less than expected, I would think that would favor the bulls more, maybe arguing against, any kind of a big inflation surge and the need to raise interest rates. So those are a couple of the things that I think we need to be aware of as we go into the end of the week. Let's take a look at what happened over the course of the past week, though. First, I'll just bring up the major indices like I like to do. You can see transports have had the best week, rising about 1 1/3%. NASDAQ up about 4/5 or 8/10 of 1%. All six, though, are up, with the Dow Jones being the laggard, rising just a little less than 1/4 of 1% last week. So we move on to sectors over the last week. Energy back at the top. You can see rising about 2 3/4%. Healthcare talked a lot. I'll show you a chart a little bit later on the XLV, but healthcare down around that key 136, 137 level. That area of price support continues to hold on the XLV, and we did bounce off of that. So that was the second best performing group over the past week, gaining a little bit more than 2%. Then we've got actually six other ETFs, sector ETFs that were up last week, and then 3 down, with real estate and consumer staples being the 2 worst and the only 2 that dropped more than 1%. So we're seeing defensive groups on the bottom over the last week, to open up 2025. We've got a couple of more value-oriented areas at the top, and then in between are most of our aggressive groups. So the good news is that the market, which has held steady and actually moved up a little bit here to start 2025, it's actually being somewhat supported by the aggressive groups. You can see industrials, technology, communication services, and financials. 4 of the 5 aggressive groups, of course, the other one being consumer discretionary, 4 of the 5 actually are up so far in 2025 to help support the market. What we saw back in 2021 going into 2022 was a market that was moving higher, a little bit higher, but if you recall, it was being led by defensive groups, and all of the more aggressive groups were down at the bottom. So this is a little bit different than what we saw then. And I've got another chart I'm going to show you in a bit that kind of points out a really important difference between where we are today going into 2025 and where we were going into 2022, because I do know there are a lot of folks looking for similarities or looking at similarities, thinking that we're going to, be off to a rough start and potentially have a rough year. And I got a different chart I want to show you. Maybe you can take a look at that. Maybe gives you a different thought process as you evaluate 2025. So let's take a look at the S&P 500 first and just look at it on an absolute basis. And I want to just break down a couple of things, one being somewhat bearish. Anytime you've got a possible head and shoulder top out there, you have to at least be aware of it. Now remember, bearish patterns, they don't confirm until they execute. So you can look at and see all the potential bearish patterns out there that you want, but until we actually execute, I would be careful about making a bearish, bearish thoughts about what you might see here during the month of January. If we break down, then I think it's worth having that discussion. But until we do, I think you just want to be careful. But if you look at the chart, you'll see from the beginning of November through the end of the year, we clearly have what looks like a head and shoulder pattern to me. I like to see at least a neckline that's flat and preferably from a bearish perspective, a neckline that is declining, which in this case we have a slight decline. And the reason I like that slight decline is that when the breakdown occurs, or if the breakdown occurs, there's no other price support. If you have an uptrending neckline, you can break the right side of the neckline and not break the left side of the neckline. So you still hold on to that support, that price support on the left side, which many times you'll see a false breakdown of a head and shoulder pattern and you go right back up because you never lose that price support over here on the left side of that neckline. But when you have a down sloping, if you break that neckline, you're below all of the prior key support levels in that neckline. So anyhow, what I did is I measured from the top of the head down to this neckline to be about a 4.3% drop from the top. So if we were to break below the neckline, which would be certainly a move down below 5,800, if we confirm that the initial measurement doesn't mean this is as far as we go, doesn't mean we'll get there and we'll bounce right off of it, but the initial measurement is what I would look to potentially reach. And that would be down just about the 5,600 level, maybe just a little bit below. That would be 4.3% below the neckline. So remember, the drop from the head to the neckline is your measurement on a breakdown of that neckline. So that would take us down to about 5,600. I don't see any major support tests if we're at 5,600, although I think on the weekly chart, let me pull this up. I believe the weekly, the 50 week, there it is. It's at 5503 right now. And if this test were to come like 30 days from now, we could easily see this up around the 5,600 level, the 50 week SMA. So just pointing that out because if we break down, maybe as we go a little bit slower in January to the downside, perhaps we hit that 50 week SMA on the weekly chart at the same time we make this measurement. So that would be something. And again, I don't know how this is going to play out. I don't even know if we're going to have a breakdown. But if we do, it's always good to be looking ahead to seeing where some of the key support levels, key moving averages would be, and potentially where it might make sense for the S&P 500 not only to go, but where it could reverse from. So just wanted to throw that out there. That is the more bearish short-term scenario where we break the neckline. That could occur on Friday, depending on how the jobs report comes out. I mean, we could see a gap down below this neckline, and we could be well on our way down to 5,600 or below, just below, if that jobs report is hot and the reaction by the market is that, hey, we're still dealing with inflation. Interest rates probably in that scenario would jump on Friday above that 4.70 level on the 10-year Treasury yield, which is where that yield resistance currently resides. I'll show you that chart in just a minute. But here's the rest of this chart that I want to show you and why I think things are a lot different now than what they were back in 2022, starting 2022. So I want you to look at all of these are kind of growth versus value or offense versus defense kind of ratios. And all of them are tracking higher right now. And they started tracking higher back in the early part of September. And if you recall, that's about the time the Fed said, hey, we're not fighting inflation anymore. We want to improve the economy. And we're going to switch now to looking at cutting rates. That's about the time that that started. And since then, I want you to look at what these more growth-oriented ratios have been doing. They've been going up. Even with the S&P dropping here, we've seen, we topped in maybe the first week of December. And if you look where we were on these ratios at the beginning of December, we're either equal or higher on all of these growth ratios. This is the QQQ versus the spider. Then I've got the XLY, consumer discretionary, versus the XLP, which is consumer staples. Then I've got the large cap growth versus large cap value ratio, mid cap growth versus mid cap value, and then small cap growth versus small cap value. All of them trending higher right now. This is different than what we saw in 2022. So in 2022, this was where we were at the end of 2021. We had an uptrend in play. So we were still moving higher. We set that early high in January, very similar to what we just did in, or at least similar to what we've done here at the end of 2024 and into 2025. We had a channel line. So wasn't a neckline, wasn't a head and shoulder top, but we did have a channel line break in the second week of January to the downside. But I want to show you what these same ratios were doing back then. While we topped, these ratios had already started going lower. Every one of them, all five, were going lower into year end, meaning Wall Street was repositioning. Rotation was already taking place into more defensive areas at the time the market topped. None of that took place in 2024. And even with the market pulling back, those ratios are still moving to the upside. That's completely different than what we saw here, where once we started weakening in January, we just further weakened. I mean, QQQ versus the spider, first week of January was already at a multi-month low. So before the weakness even started to kick in, that rotation was taking place. Same goes with consumer discretionary. By the second week of January, we were down at multi-month lows on this ratio. Large cap growth versus large cap value already starting to roll over and really started to fall apart. Mid cap, small cap already moving much lower heading into January. And by the time January started, mid caps and small caps, growth versus value, and large caps all were falling apart. So this is one of the ways the market works. You get Wall Street rotating into more defensive areas before we get a lot of selling to take place. I haven't seen any of that. So I'm skeptical. I don't follow the news, the media, the headlines. I look at these things. This is what matters to me. This to me is the news. This is the headlines right here. You know, growth stocks were falling apart going into the high in January of 2022. As we go into January 2025 with a bearish pattern, we've got these ratios moving higher, not lower. So you can make of it what you want, but to me, it's a really important sign that's telling me that Wall Street is not positioning for a big downturn like it was back going into 2022. 10-year Treasury yield, just wanted to point out here is a major short-term level here, going back to the April high on the yield at 4.70%. We closed today at 4.69. I mean, we are right up there just as we're getting a big non-farm payrolls report. So I think interest-sensitive areas could take a big drop on Friday or could take a big leap on Friday, depending on what happens with the jobs and what happens in the bond market. So just wanted to point that out. It's something really important to watch. All right, if you are new to EarningsBeats, love to have you come over to EarningsBeats. Check us out. You can go to our homepage. Again, it's both words are plural, EarningsBeats.com. You can start a 30-day no-cost trial to our paid service. That requires a credit card. You could scroll down and you'll see an area where you can fill out name and email address. Will take you to our EarningsBeats Digest, a free newsletter, which comes out twice a week, Mondays and Wednesdays, just talking about a lot of the things that are important to us. I think they're very educational in nature. They're also very brief. It's usually one chart and two paragraphs. So you can read it really quickly. Could be a trade setup. It could be something on sentiment. It could be something about how I'm evaluating the S&P 500. It could be a lot of different things. As we go into earnings, I can tell you that I do like to feature a lot of companies that are gapping up with key earnings reports, highlighting some of the key support levels on a pullback that you could watch for. Anyway, it's great information. We've had tens of thousands of folks that have subscribed to this free newsletter. It's just a way for us to give back. So you can always go over to earningsbeats.com, scroll down, and sign up for that. If you're on your mobile device, by the way, you can you can use the QR code, scan it, and it will bring you to a landing page for our recent Market Vision 2025. We are now selling the recording, so you can claim your copy. You can save $100 from the live. Um, you can get the full recording for $697. It was $797. Also, with that, you will get a bonus offer, 1 year of free membership with EarningsBeats. That's a $1,000 value, $997. So by buying the recording, you're saving $300. If you had gone in and signed up for an annual membership. So anyway, that's a great deal. Also, if you just want to check out one area of the recording, I actually gave one of my key trading tips, my number one trading tip for 2025. And so we'll give you that 30-minute recording. And then that will set you up for a 30-day trial for our service. And then at that point, you'll either have to pay the full price, the $997 for our annual at the end of that 1 month, or you can renew for just 1 month at a time, but that's $147 a month. So clearly, getting the recording, checking out our market outlook for 2025. Again, if you purchase the recording, get a full year of our service for free. That's something you need to at least consider. Love to have you. All right, let's keep moving because we've got some more to go over here. I wanted to talk about some areas of the market over the last week that have kind of caught my eye. One being the XLV. If we go to that longer term weekly chart on the XLV, you will see, I've talked about this in the past, multiple tops right around 137. Over a 2-year period, we broke out above that level, got up to 145, went back to that 138 area, then up to 160, and now here we are testing that key support level again, and it looks like we're starting to turn up. So the XLV, after coming back down for 3 or 4 months, looks like it's in a great reward to risk spot from a long position perspective. If you fail to hold 135, you could get out pretty quickly. But I think this is an area of the market that could maybe push back toward its recent high. So I wanted to point that out. Semiconductors. It's hard not to talk about semiconductors because back on Monday, we had a gap up that cleared multiple months of recent highs at 21,000 on the Dow Jones US Semiconductor Index. And so that breakout there, we did pull back, but I've had a change in my trading strategy over the years. It probably goes back 7 or 8 years. I don't remember exactly when I made the change. But the way I used to approach the market is if I got a breakout, I was very bullish. But if I couldn't hold the level of that breakout, I would then immediately grow more bearish because it didn't hold the breakout. As I've gone and looked more and more at the market, what I've seen are breakouts, sometimes followed by false breakouts and a test of the 20-day moving average. If you look at the Dow Jones US Semiconductor Index, the 20-day moving average came in at 20,139.74. Today's low was 20,092.04. So we went a little bit below the 20-day moving average today, but came back up and held it into the close. If the non-farm payrolls report on Friday are more bullish, I could see a big gap up on the semiconductors and maybe start pushing toward a high. It seems like right now we're in a short-term little channel. I'm just talking about the last 3 weeks or so, but you've got the highs going up and the lows going up at about the same pace. So we got a nice little channel created, and this test of the 20-day could launch this group back to the upside. I know it was a disappointing failure on Tuesday, but today with the market down, we saw what looked like could have been a breakdown on this group, and they rallied back and held the 20-day moving average. Something to at least consider. How about home construction? Well, if you look at home construction and you look at that 10-year Treasury yield, which is a kind of an indicator, it kind of gives you an idea of what the mortgage rates are doing. It's kind of a barometer for the mortgage rates. Anytime that 10-year Treasury yield's going up, that's a headwind for home construction stocks. But when it comes down and we hit that, let me go back and show you again, we're hitting a major resistance level right here, yield resistance. So with that non-farm payrolls report on Friday, we're either going to get a breakout above this and maybe start to move toward 5%, or this could be a double top and we start to move back down. Whichever way we go on the 10-year Treasury yield will give us a really good indication as to where we might be headed on this home construction chart right here. Key support at 2,300, multiple tests at this 2,300 level over the last year. If we break that level, the last breakout occurred at about 2,050. So those are the two key levels to keep in mind. My bet is that 2050 holds home construction and eventually we turn back up. But we have a chance to turn right here. And I think a lot of it will be dependent on Friday's jobs report. How about the transportation group? Like many of the more value-oriented or interest rate sensitive, economically sensitive areas of the market, transports took a big hit throughout the month of December, trying to kind of get their feet under them as we go into 2025. Nice breakout above the 20-day moving average would be nice. But right now, transport's trying to hold this area of support, which also dates back to the support we saw in October and November, or maybe twice there. October, the low at 15,700 and then again around 16,000. That's been the area where we've been holding support here at the end of December and into early January 2025. So I'd like to see this turn around, maybe get that breakout above the 20-day moving average. Internet stocks, just want to remind you, if we go back to 2013, which is when this secular bull market started. So since 2013, and I'm looking at the internet group relative to the S&P 500, its relative performance has been up 12 of the last 13 years. Internet stocks tend to love the month of January, mostly because of Meta and Netflix. Those are two key internet stocks that tend to do well in January. Netflix hasn't been doing very well recently, but they do have earnings coming up later this month. And that's one that I'm watching for to get a reversal. That could have a big run, perhaps, into its earnings report. So watch both of those as we move forward. Also wanted to show the chart on the internet group. You can see the double top, nice little cup, handle, breakout. This would measure from 4,800 up about 800 points to about 5,600. And right now we're at 5,100. So another double top, actually triple top above about 5,200. A breakout above that. Again, we could see that on Friday, depending on which way this jobs report goes. But that would be an indication that maybe Netflix, Meta, and some of these other internet stocks are ready to maybe challenge recent highs or maybe even break out again. All right, last thing I have for you, I wanted to go through a few stocks here with you. Nvidia. So there are a few areas of the market that tend to lead the S&P 500, especially during a secular bull market. One of those areas is semiconductors, and Nvidia at the most recent high back here in early mid-November, you can see on a relative basis, it was a leader. So I like to look for leaders. So during this pullback, it's pulled back a little bit with its relative strength, but it is trying to break out. It came down, tested its moving averages. And again, depending on what happens Friday, this one could be off to the races, or maybe it's going back down to retest the recent lows just below 130. Those are the two possibilities that I see. We'll see which one takes place on Friday. Next up, Palantir. I like this test of the 50-day moving average. We haven't seen one all the way since the beginning of August. AD line great, relative strength great. This is one of the best software stocks out there. That is pulled back from 85 to 66 today, 66 and change, right near that 50-day moving average. I don't know if the 50-day holds, but what I can tell you is that from 2 or 3 weeks ago, Palantir's reward to risk is much, much better now than it was. Just keep in mind, it's an incredibly aggressive stock, not for everybody. If you're someone really paying attention to capital preservation, Palantir is probably not the best stock for you. You got to have that more risk on mentality. Next up, Reddit. So Reddit, if we look at the internet group, you can see Reddit has been one of the leaders along with Meta and with Netflix. It has been moving up, great volume trends. This one, if it fails to hold that 20-day, could be a quick trip to the 50. So maybe watch these two levels. But it also, we might see that break right back up off of the 20-day. That's what's been holding Reddit for the past 6-8 weeks. Really, it's been holding it going back the last 3 or 4 months. We've been above the 20-day moving average. So let's see if that continues. But I wouldn't be afraid if this thing does test the 50-day. A nice reversal on the 50-day would be a great entry point. And then the last one I have for you is Astera Labs. This is a stock that I really like. It's in the computer hardware space, another area, key area that tends to drive the market during secular bull market advances. You can see ALAB over the last 4 or 5 months, just absolute tremendous relative strength. There's great volume trends on this move up. AD line remains high, even though we've seen some sell-offs, a couple of sell-offs in the last couple of weeks. And again, this one's been holding that 20-day, but I wouldn't be shocked at some point with a 50-day test, but I do like this stock to go higher in time. All right, so that's it for me. If you want to kind of follow, what we do at EarningsBeats and you want to follow my work, I'm going to have a slide up here again with a QR code. You can scan that code, come over to a landing page which shows you all of the information that you need to see in terms of how you can follow me, how you can follow EarningsBeats as we go forward. But that's it. We got the first week of 2025 in the books. I thought there were periods of bearishness, periods of bullishness so far. I don't think either bears or bulls are totally in charge. Although what I will say is going back to that S&P 500 chart, it is different than what we saw back in 2022. I'm not seeing Wall Street moving into areas that are giving me concern and heartache. And as long as that remains the case, I'm going to stick on the long side until a potential breakdown or those ratios start to change. So that's it for me. Everybody have a great rest of your week. Enjoy the weekend ahead, especially if you're an NFL football fan. Lots of football coming up this weekend, playoffs. And we'll be back next week to do it all again. So have a great rest of your week, everybody, and happy trading.